Good afternoon and welcome, everybody, to this event on the case for radical banking reform. And I'm delighted to introduce my friend, Larry Kotlikoff, a friend of many, many years. We were classmates together, so I will not tell you how long we've known each other. But Larry is...
since the Middle Ages.
Since the Middle Ages. Is professor of economics at Boston University. He is, of course, one of the best-known, most prominent macroeconomists. And he is a fellow of the American Academy of Arts and Sciences, fellow of the Econometric Society. He was a senior economist on the President's Council of Economic Advisors. He has done wide-ranging work in macroeconomics, best known perhaps for his work on generational accounting, which began a long time ago when he was a graduate student, and working with Martin Feldstein. But today's topic is based on his book with the, in my view, unlikely title, Jimmy Stewart is Dead. This book was just very recently published. You can find it on Amazon. And it makes the argument for a radical reform of the way banking is conducted. To discuss Larry's presentation and the book, I'm delighted to welcome a colleague from a much younger institution than the Carnegie Endowment, the Brookings Institution, here next door. And Doug was an investment banker for 2 decades, principally at J.P. Morgan. So in addition to his scholarly work, he brings enormous practical experience to the issue of banking reform. And he has done a lot of work on both public and private financial institutions. So he is admirably qualified to comment on Larry's presentation. We're hoping to have 1 or 2 more people come who may also be adding to the discussion. I'll tell you when and if they arrive. So I think without further ado, I'm going to ask Larry to present for about 20 minutes, and then Doug to follow with discussions and commentary, and then we'll open it up. I very much hope there's an important soccer game on tonight for those of you who are European inclined, and so I very much hope we can certainly get out of here a little before 7. Larry.
Is the U.S. playing?
No, the U.S. is not playing. Europe really needs a boost today, I tell you.
Okay. Yeah. Well, it's a pleasure to be here, and thanks for coming, and thanks, Yuri, for setting this up. So Yuri described what I'm going to propose as a radical banking reform. I would say it's actually a safe banking reform. I would say that the status quo is a radical banking situation. The reality is that we've seen the impossible happen. We've seen pretty much the collapse of a good chunk of the banking system, and things that were just unbelievable occurred, as you know. I think we're in an even more risky position right now. I think what's happened is that the U.S. government has seen what AIG did and has taken over that role and become AIG to the 10th power. I'll just give you a nightmare scenario. Let's suppose that the public starts to understand that the U.S. is in worse fiscal shape than Greece. The Chinese start to dump U.S. bonds. Interest rates start to go up. people start to realize that the only way the U.S. government is going to deal with its fiscal problems is to print money. And just suppose we would have a run on the banks, on the U.S. banks. As hard to believe as that is, that's a small probability event. But again, the impossible to believe and imagine has just happened. So let's imagine something else that's, quote, impossible to believe. Suppose there was a run on the banks tomorrow morning. The FDIC would have to print about $6 trillion because that's what their obligations are. They have about $18 billion in reserves last time I looked. Then the government would have to print another, not the FDIC, but the Fed would have to print the $6 trillion for the FDIC. The Fed would then have to print about $3 trillion to cover the money market accounts because they would surely be run on the minute after the banks were run on. Then there'd be a run on the cash surrender values of the life insurance policies, which are about $3 trillion. Then the U.S. government has all kinds of obligations that it's committed to cover, which run in the tens of, perhaps, I don't know, somewhere maybe around $10 trillion. We could quickly see the printing of over $10 trillion. Everybody would therefore expect hyperinflation to arise. Therefore, everybody would run on the banks, would want to run on the banks, because if you didn't get your money out right away, you would end up with your dollars because they're, quote, insured, but you wouldn't have your purchasing power, which is not insured. The FDIC insurance is really a myth. It's a fraud. It's a convenient fraud, and it's worked for a long time, but it's not actually real. And when the government has spent the last 2 years guaranteeing everything left, right, and center, making commitments that it can't really cover, then it's really acting like AIG, which is insuring the uninsurable. That, to me, is a very risky position because it could lead to complete meltdown of the financial sector and of the U.S. economy. So that's risky. What I'm proposing is safe. What I'm proposing is that we transform the banks and any other financial institution that has limited liability. I'm drawing a line in the sand, not the way Paul Volcker is drawing a line, which is between commercial banks and investment banks, or good banks and bad banks, but between companies that have limited liability, financial intermediaries with limited liability, and those without it. Any financial intermediary, whether it calls itself a bank, a commercial bank, or an investment bank, or a hedge fund, or a private venture capital fund, or an insurance company, any of those companies that have limited liability or organized as corporations or as LLPs would have to operate in one way and one way only, which is as mutual fund companies. So they would sell mutual funds. The mutual funds themselves are 100% equity financed in all states of nature. There's never any liability that goes beyond the resources of the mutual fund, and therefore the mutual funds themselves can never fail. The mutual fund companies, the holding companies, the mutual fund parent, like the Fidelity Investments or the TI Crafts or T. Rowe Price, these mutual fund companies themselves can't fail because they're just borrowing to run their mutual fund business, to build, to buy computers and desks and buildings to run their business, but they're not borrowing to invest in risky assets. That would be precluded. So you have, under what I'm proposing, a financial system that is immune from collapse. It can never fail. You can never have financial collapse again. Financial collapse and bankruptcy has been the hallmark of a lot of major recessions and even the Great Depression in our country, and that would not arise under limited purpose banking. So we would go to a safe system where the banking system and the insurance system play the role of honest intermediaries, connecting people that have funds to invest or to lend to those who are trying to borrow and invest. Yeah, those who are savers and are willing to give their money to other people who want to borrow or invest. So this is what Mervyn King has called for, well, let me say he's called for limited purpose. He's not called directly for limited purpose banking, but he's called for utility banking as the way the banking system should be organized. And limited purpose banking is a form of utility banking. There's a feature of limited purpose banking which goes back to the narrow banking proposal that was presented by Frank Knight and Irving Fisher and Henry Simons back in the 1930s in what was called the Chicago Plan. And what they were saying is that we should have deposits fully reserved. There should be 100% reserves against deposits. Well, narrow banking, that part of that aspect of that would be one aspect of limited purpose banking, but it's really a narrow aspect of limited purpose banking because one of the mutual funds that the limited purpose mutual fund companies would be offering on the market would be cash mutual funds, which hold just cash, 100% invested in cash. I'm talking about cash. I'm not talking about treasury bills, treasury bonds. I'm talking about a cash mutual fund that holds cash. Now, that would be the only mutual fund that would be back to the buck because there would be $1 there for every dollar that's put in, except for the fee that the cash mutual fund would charge for holding your cash. That cash mutual fund would be the counterpart of the checking accounts that we have in our current system. So that would be the payment system. We'd be using the cash mutual funds for the payment system. We would be able to write checks on our cash mutual fund. We'd be able to get our cash out of our cash mutual funds using debit cards. We'd be able to get cash out of ATM machines, drawing on our cash mutual funds. Every other mutual fund would float in the marketplace. Nothing would be back to the buck. Every prospectus would say, this fund is risky and is not back to the buck. That would be in big letters at the very top of the fund prospectus. The other type of mutual fund that would arise here would be insurance mutual funds. I'm just saying the other type that's not already there. We have to realize that a third of the financial system today is mutual funds. Mutual funds hold a third of the financial assets. So this glass here, financial system, is a third full already. I'm trying to fill it up all the way to the top. If you think about the financial crisis, there were a lot of glasses. The ones that are all broken were not the mutual fund companies. By the way, I don't work for any mutual fund company. I'm not on anybody's payroll. I don't do any consulting for them. Just to know, so you know, I'm not a shill for the mutual fund industry. I think a lot of what they're doing sucks, to put it technically, in terms of their fee disclosure and their disclosure about what they're holding. So just to be clear, I think they need to, there's some reforms that have to be occur there as well. But if you look at this financial earthquake that we just had, some of these glasses are still standing. The rest are in pieces. And we want to rebuild. What the Congress is up to right now is to rebuild the shattered pieces in the same material. They want to rebuild in straw when there was concrete that was used, and that stood up. Most of us have most of our assets in mutual funds. So for most of us, our banking system is mutual funds. You've got to realize that most of us are middle class and lower income, and we have most of our assets in retirement accounts, and retirement accounts are held in mutual funds, or we invest in mutual funds. When Congress set up the 401k system, it made sure that it was set up in a way that the middlemen would not be able to steal our money. So there's third-party custody, and there's certainly much better disclosure with mutual funds than there are in the rest of the financial system. Now, that's one part of what this proposal entails. The other part is a single regulatory agency, which is called the Federal Financial Authority, which would make sure that all the securities that the mutual funds hold and buy and sell are verified by this federal agency. That's to say the income statements and employment statements, any other statement on these securities would be verified by the single federal agency. The collateral values would be appraised by this federal agency, which would hire independent appraisal companies that are not conflicted. What we saw in this financial crisis was the sale of snake oil. We saw liar loans where people lied about their income, they lied about the appraised value of the collateral, and they manufactured $2 to $3 trillion in what are now called toxic assets. We don't know how much of that $2 trillion or $3 trillion of subprime securitized mortgage debt is actually toxic or not, because it wasn't disclosed. Anyway, this federal financial authority would verify all these income the statements. It would get the appraisal done correctly. It would hire companies to independently rate the paper, so we wouldn't have insider rating, and it would require third-party custody, which is required for all mutual fund companies under all mutual funds under the 1940 Investment Company Act, and then it would disclose all information about the securities on the web in real time. So if Yuri comes to my mutual fund company, my limited purpose bank, if you like, to borrow money, what I would do is process the paperwork. I'm Citigroup. I have been transformed into exclusively a mutual fund company. My investment banking business has turned into a consulting business. My trading business has turned into a matching of buyers and sellers. I've got no exposure. And my commercial banking has been turned into a mutual fund business. So Yuri needs a loan to buy a house from Doug. He comes to me. I take his application. I send it to, your name is? Tom. I sent it to Tom, who's the head of the Federal Financial Authority. Tom's going to check Yuri's income statements based on federal tax returns. He's going to send out appraisers to double check the appraised value of the house. He's going to get Yuri's paper rated. And then he's going to disclose it all on the web. And he's going to send it back to me. And then I'm going to put it up for auction to my mutual fund, who's investing in mortgages in this part of Washington, this part of the country, and other mutual fund companies who are investing in mortgages. And this mortgage will get funded, and Yuri will get to buy the house, and the money will go from, once it's funded, it will go from my mutual fund, whichever mutual fund buys the mortgage, the money will get wired to Doug because he's handing over the house. So Citigroup itself, as a holding company, is never holding any liability here. It's not got no exposure at any point in time. And the credit then is going from whoever invested in this mutual fund that gets the bid. Let's say that's, your name is? John. John invested in a mutual fund that, what's your name?
Rain.
Rand? So Rand set up a mutual fund with Deutsche Bank. You successfully bid. You got Tom to invest in your mutual fund. You're providing credit to Yuri through Tom's mutual fund. So there's credit provision. We already have mutual funds, 8,000 mutual funds in this country that are investing in mortgages, they're investing in treasury bills and in tips, inflation index bonds, or investing in cash. There are cash mutual funds already. They're investing in equities from all over the world, index funds or Pacific Basin. They're investing in junk bonds. It's already happening. Financial intermediation is going on through mutual funds as it is, and they didn't collapse. They're not in shattered pieces. Now, the insurance companies here, I'll tell you about the insurance companies, and I'm going to turn things back over to Doug to say why all this is impossible, perhaps, or
Just most.
And then I'll tell you why it's possible. What's really impossible is keeping the system going when you have a $600 trillion derivatives market, and you could set whatever capital requirements you want. All it takes is one trader who's not sufficiently babysat by one regulator of the 120 regulatory bodies we're going to end up with after the new legislation. all that one trader has to do is make some trade for $1 trillion or so with a couple keystrokes, and bingo, we'll have a company like Citigroup owing $1 trillion. It'll be too big to fail, and bingo, the U.S. taxpayer will be out $1 trillion. That's a lot of money. That's the kind of thing that can bring the economy to a standstill like it's been brought. I think I need to tell you two things. I need to tell you about the insurance mutual funds, and I need to tell you about the Tylenol scare in I think it was 84, and then I'm going to be quiet. The insurance mutual funds would work like this. Let's suppose that we're all young females of a certain age and we're trying to buy life insurance, and we all have passed a certain medical exam, and that's the kind of thing that would the insurance company now require to buy life insurance. You take some kind of a test. They come and give you some blood test and so forth, and check your heart rate and so forth. So we're all young, middle-aged females, let's say, and we put our money into Tom's, not Tom's, your name is? Peter's life insurance mutual fund run by John Hancock. And it's a 3-month closed-end fund. We give him our money, and the money's invested in Treasury bills. 3 months later, the Treasury bill money, the Treasuries are there plus interest, less Peter's fee. That's the pot. And those of us who die get to collect the pot less the fee in proportion to what we put in. That's to say that our survivors get to collect because we're going to be dead. But those of us who didn't die collect nothing. Now that's an insurance pool. The ones who die win. They lose in the sense that they win in the sense that they get paid off. The ones who live lose. They get nothing. A longevity pool is where we put money in this in a mutual fund, and the bet is on whether or not we survive. Those of us who survive get to collect out of the pool. Those of us who die lose, get nothing. Now, think about the life insurance pool. If more people die, the pot is the same, less is going to be paid out per decedent. So there's no attempt to insure aggregate risk, which is what we have under the current system. The current system has life insurance industry saying that we will cover your policy. We'll pay you off your life insurance face value of your policies no matter how many people die. If swine flu were to break out and kill 2.5% of the policyholders of American life insurance companies, not only would it kill millions of people, but it would kill the insurance industry, which would probably bring down the rest of the financial system. The insurance industry is sitting with, as I mentioned, $3 trillion in cash surrender value that could be run on tomorrow. If people start to realize that the insurance companies only have $8 billion in reserves in their state reserve funds to cover trillions upon trillions of dollars of life insurance liability, and that they've insured the uninsurable, that they've played AIG's game, there can be a run right away on those cash surrender values, and the insurance industry can go down at the same time all these people die. What I'm proposing is no insurance of aggregate risk. The other type of insurance policy that would, so all these policies I've mentioned here, life insurance, longevity insurance, you could run car insurance, health insurance, homeowners insurance, all through what are called what's really a tontine structure. This insurance structure dates back to the 1600s. It lasted for several hundred years. The first physical location of the New York Stock Exchange was the Tontine Coffee House. So this is ancient finance and modern finance combined. Let me tell you about another ancient type of financial instrument, which is called the parimutuel fund. If you go to the racetrack, you're engaged in, you're investing in a mutual fund during the course of the race, whose structure was developed in 1857. It's been used for betting at racetracks around the world since then. And we would have people betting. Let's suppose that all of us wanted to bet on whether or not IBM defaults over the course of this year. So we come to, your name is? Ben. Ben sets up a IBM defaults or not mutual fund, closed-end mutual fund. It closes on January 1st, 2011. We invest, and we put our money down, and we give him our money, and at the end, it's invested in treasuries, one-year treasuries. At the end of the year, those of us who invested on the basis of IBM defaults will collect if IBM actually defaults. If it doesn't default, we'll collect the pot in proportion to how many of us there are and what we invested into the pot. And if it doesn't default, the rest of us will collect the pot. That's what's called a CDS. That's a credit default swap. But that's a credit default swap in which there's no liability to any third party. The taxpayer is not responsible for the losses of the people that lost out in that bet. You can have the bet being on whether or not IBM stock goes above 50. That's an option. You can have the money that we give to Ben can set up a CDO mutual fund where the money is put in. He invests the money in mortgages. Different ones of us take different tranches. At the end of a certain period, we're paid out. And there's nothing wrong with securitization. There's nothing wrong with modern financial instruments. What's wrong is the fraud and the fact that